Right, wonderful question about pensions and investing that I've just received. What other instruments do you teach other than US? Well, actually, my 10,000 stocks covers not just US, but London Stock Exchange as well, and European stocks, which you can buy into US, which are listed in the UK, and you can buy into a UK SIP, as well as international companies listed on the New York Stock Exchange. So 10,000 actually. For example, if we were dead confident that a portfolio should make over 10% in pure delta, then why not increase the leverage and trade options? Because I wouldn't be dead confident. Where I am dead confident about something, then it tends to be, if it's a 12-month holding, 2 times leverage over 12 months, less leverage if you're holding for a longer period of time, and I'll explain why in a second, because it'll go through ups and downs basically. I'd get margin calls if I had a 10 times leverage, because the longer time you're holding it, the more depth it could drop. So a Microsoft 2 times leverage ETF I don't have a problem with, and of course using derivatives over a long time becomes very expensive. So that's point number one. In terms of shorter term, if I'm dead certain, it's easier to be certain over a short period of time, perversely you might think, because you're only in the market for a short period of time, and if you're wrong, you can get out very quickly. So there I can have a far higher amount of leverage because I know I'll be watching it like a hawk. It's for a short period of time, but that's trading and it's not investing. So that's something else. And on the other hand, if the markets tank, then, well, let's take 2022 where the markets dropped 25%. What you'd do is you'd say, if it drops X percent, I'll exit Y percent, which is probably the easiest way. There are other ways, but at least mathematical means that it's not open to misinterpretation. Everything else is. You talk a lot in your videos about US stocks. While this looks good, my overriding concern is managing downside risk. Fine. A, what loss controls do you advocate? One is there that I told you, other than presumably continue reviewing and adjusting stop orders. Not reviewing and adjusting. If it drops X percent from the highest it's been since you bought it, sell, hold for 12 months. If it drops 25%, another simple one is if it drops 25% from your entry price, exit. Okay, you might say, well, how do you know that's going to be perfectly correct? I don't have a time machine, but we need something, and that's actually not bad. Would you be able to teach me how to manage my portfolio as a black swan event where the event tanks and the regulator stop trading before your stop orders are executed? Yeah, what you're talking about there is where the regulator stop trading before any orders and the market tanks is a nuclear explosion which wipes out humanity. I can't teach you how to handle that. How do you hedge? I don't. I'm long in the markets. The biggest hedge is my watching it on Wednesdays and Fridays, because too much watching will drive you insane and not good for your mental health. And the rule that I mentioned is it's monitoring and a stop loss rule. It's part of your portfolio bonds, gold. Nope. I think what you mean there is how do you diversify? No, I don't have bonds. I don't have gold.